Disclaimer. This material in this presentation has been prepared by ADCM, LLC DBA Willow, and is general background information about Willow's activities, current as at the date of this presentation. This information is given in summary form and does not purport to be complete. Information in this presentation should not be considered as advice, or recommendation to investors or potential investors, in relation to holding, purchasing or selling securities or other financial products, or instruments. Neither the information nor any opinion expressed herein constitutes an offer or a solicitation of an offer to buy or sell securities. Before acting on any information, you should seek independent financial advice. All securities and financial products involve risks. While due care has been used in preparation of this presentation, the information contained herein has been obtained from sources believed to be reliable, but its accuracy and completeness cannot be guaranteed. Forecasts and hypothetical examples are subject to uncertainty and contingencies outside Willow's control. Past performance is not a reliable indication of future performance.
All right, so we're just going to give it a, hey everybody, welcome. I'm Paul Farella, Managing Director.
Yes, Alexander Desk. Yep.
We're just going to wait for people to fill in for a minute or so. In our typical fashion, we're going to go over some of our risk indicators and then touch on some more contemporary issues that we see happening out there in the world. And then we will go right into our questions because we were sent some pretty good ones.
Yeah.
So
a lot of questions.
we'll be happy to get into those. So
self-explanatory.
Yep.
Our proprietary volatility index is showing an uptick clearly. The markets predicted this direction. If you know, like and Paul and I will talk to this, we started raising cash in the portfolios in November. We asked for your patience. We continue to ask for your patience. You will see as we go forward, some of our risk indicators are starting to show there's more risk in the system. I'd say the biggest concern that I would have, and Paul too, is that we run into some form of credit risk down the pipe. I mean, that's not the biggest concern we have, but I think we have much bigger concerns around war and such like that. But when we're just talking
financial markets.
Yeah, exactly. So volatility is on the rise. We don't like that.
There's the credit default swap spreads, which also really since November have been on an upward trend. And as these spreads widen, or the number goes up here, essentially it's saying that the chances or the cost of insurance on companies going bankrupt is getting more expensive.
Now, this isn't crazy high. So I want to make sure that when we look at this in respect to history, this isn't, this is not financial crisis high, just so you know. It's about direction. That's of importance to us. And so directionally,
change in direction and the velocity of that change are really what we're looking for.
Yep.
And this is a break from, I guess, the past year or two and how these charts have traded. So worth paying attention to.
Exactly. And ironically, you will see that there was this slow, steady uptick by November of last year, which is also when Paul and I recognized the rolling over of the market. So there's that. Let's go forward. Bond spread, same thing, and this is not yet, again, this isn't at a place where we are highly concerned. I want to make sure you know that this is probably one of my favorite indicators, because this is something that got me out of Enron and WorldCom and, a lot of the tech companies back in 2000. So these spreads to me are probably one of the most important aspects of our work. Still not, while again, it's directionally going in this direction we don't like, it's not at levels that says, okay, we're full on credit risk at this time. Oh my goodness.
Inflation. So back in what was it, October or November, we had said that
October,
early Q4, we had said that inflation would not be transitory. And
if you followed our work for the last 10 years, one of the things that we said is that inflation would be going higher in the necessities of life. So there is only so much impact the Fed is going to be able to have with necessities. Okay, we've been saying this for a long time. Insurance, health insurance, healthcare costs, food,
Mhm.
okay?
Energy.
Energy, right. So now you're seeing this externalities taking place that's bringing oil to over $110 a barrel. Our work showed we were going over $100 a barrel. It showed it last year, and it's got, which is why we took positions in energy middle of the year last year. It's going in that direction, and unfortunately, we don't see. I don't want to say we don't see an end to it, because that's, but I can't see anything in the charts at this point, anything in any of our work that says that this inflation cycle is beginning to wane. We just don't see it. So, so we really, and now the Fed is starting to talk about the fact that they may not have the arsenal to deal with the impact of inflation right now. So, you know, they are confirming what we're already saying. So let's see how we go forward. It's not to put us in panic. It's just that at this point, we can't see something in any of the charts that we look at, in any of the data that says this is coming to an end yet.
Yep. And one of the ways we can keep track of this too is by watching the bond markets in general. Another reason why we watch those spreads, but also that market tends to telegraph in advance sort of how inflation will play out. And right now, it's sort of telling us that what we see here, this increase and rise, is most likely going to stay for a while.
Yeah,
Unfortunately.
Okay.
So this chart might be hard to see, but this is just a picture of the S&P 500. You can see it's sort of rolling over at this point, which has been since October, really. Markets hit its peak around November last year on extremely light volume. So this is why we pay attention to this sort of technical stuff, because it sort of telegraphs what you can expect going forward, right?
So to just back up a little bit. So the NASDAQ was breaking down prior to, and in the NASDAQ, if we had that up, has a more classic, I don't think we have that chart here, right? Okay, has a more classic sign of double topping. So if we look back at the NASDAQ from like September, October, we can see where it was not hitting new highs, even though some of the bellwether companies were hitting new highs at that time. But it's very fair to say that a lot of the technology, which is bouncing, by the way, right now, and we look at it as simply a mean reversion bounce. We don't see this as a healthy bounce. Nothing has changed. It's just typical chop in markets where we have mean reversions, and that's what we're experiencing now. But if you look, the NASDAQ was breaking down from September, October, and then when you look underneath the surface of the S&P 500, which I showed last month, you would see that the components underneath the S&P 500, the stocks themselves, most were breaking down by the end of the year.
Right, the top 5 or so companies in the S&P 500 make up something by, I think it was 30 to 40% of the index.
And that's like the Google,
right? The Googles, Apples, Facebooks, those types of companies. And so while they, based on their size, have been able to weather some things a little better, a lot of the other constituents of the index have taken massive hits. Some down 60+%.
Okay, so that's what's going on here. So we see that there's a little bit of a mean reversion bounce here. We're looking at volume. We're not too high on the volume because the volume is very light on any up days. At this point, we have not seen and the volume, remember, is the weapon of the bull market. The volume is the weapon of the bear market. We have to see volume expand and for an expansion in the stocks that are participating, and we just don't see that at this
time. And to go back to one of our most of our risk indicators, they do show sort of like what am I trying to say? I lost my thought.
We can lose our thoughts. It's all right. You know, we're always thinking. Okay, let's go on. Okay. Oh, wasn't it a good one? You'll come back with it. Okay, so macro issues, what keeps us up at night. And this is a slide that we've used, I don't know how many times over the last webinars, but we want to just remind you, you know, these are calls that it was as far as August even. You got it back. Oh, wait, he's got to go back.
So as things like volatility go up, right? It introduces more uncertainty to markets, and markets really don't like uncertainty. So when you see things like volatility increase, you also see things like the market here go down. And until that volatility comes back down, volume probably won't return until there's more certainty in markets. And so back to this, what keeps us up at night? There are many things out there right now that are causing lots of uncertainty and causing a lot of people to hesitate or question what's actually going on. A lot more fear is introduced to markets as a whole in general. And so until that trend sort of changes, we're in general taking a more defensive position.
Yeah, markets don't like uncertainty. I think we always live a life of uncertainty anyway, because we all just never know when our day comes, right? But we want to at least be able to have some predictability in some of our indicators, and at least some solid ground by which we can hold. And the overall themes continue: power consolidating to the top. This is happening not only with wealth itself and oligarchs, but oligopolies. This is happening. High debt. This, what I'd say here, is the difference between now and 2008 is a lot of the debt now is at the government level, local, state, federal level, high debt. So if we have any sort of credit issues, we are going to be facing a situation we haven't faced before, where the debt now is the debt in the government level is extreme. I think we're all experiencing the supply chain disruption. Go ahead and try to order a refrigerator and let us know how that works out for you. And stagflation, right now, we still have had decent GDP growth, still has been there. And we do think that we can now go, with the Fed raising rates, go into a cycle of stagflation. And we are starting to see a slowdown in housing that is starting to take place. And of course, civil unrest, which, we worry about, anarchy and what can come from that. This is for real. We're starting to see some more disruption, and now of course we have a war we're contending with. That's what are the net effect of that? It all smacks to saying very conservative at the moment.
Right. It's sort of our theme for the 2020s is that this decade as a whole, due to all sorts of different cycles and macro factors, is going to be a volatile and interesting one.
Yeah. So this decade, is a trend. We think, to a certain degree, is a transitional decade for a number of reasons, which maybe we can actually do a webinar just on that.
That could be its whole
it could be a
thing.
Portfolio positioning, we have been raising cash since November. We added energy last year, thank God, right? So we had no idea that, well, we did have an idea. We are overweighting defensive sectors. This is all kind of commonplace: utilities, food, things that are necessity. Underweighting technology, even though, and let's be clear, we are firm believers in technology. We are firm believers in the artificial intelligence, the robotics, everything that's being developed.
It's just that some of these companies were trading on insane multiples. And even with, I was looking at like Zoom, for example.
Oh my God.
Even down 60+% from its high, it's still trading at a 27 PE.
I mean, that's
still extremely absurd.
And we owned that stock at one time. Thankfully, we're not in it anymore. But right now, underweighting technology, there's a time to own growth stocks and time not. This is a time not. And then, of course, we're always considering alternative options, which, we may consider some potential shorts, but through or covered calls or just certain things to protect the portfolio. And of course, Paul and I like our cryptocurrencies as well, which I think we're touching on at some point, or at least we're going to be addressing some questions. Okay.
More focused.
Okay. Okay. Oh, okay. So then let's get to our questions.
So I'm going to stop
sharing.
Share so we can see everybody.
Okay.
Feel free to, in the chat or in the Q&A box on Zoom, to type in anything you'd like to us, and we'll try to address it. But in the meantime, we have a couple, or several questions that were submitted.
And I see we have quite a few new people on the call with us. So I want to reiterate, for those of you who have not been on the call previously, Paul and I have taken a conservative posture starting in October of last year, where we started protecting our gains, taking our gains in the portfolio. At the end of the year, we lost a little bit of alpha. In other words, the market continued to go higher, even though underneath the surface, it was breaking down. We are very happy we did that as we went into this year. So as we said before, sometimes it's better to just sit and wait and see how things are going. So to have some cash on the sidelines, maybe have some shorter term bonds, which we're looking at for you, at least in the near term. It's not where we want to be long term, because we know inflation is running at a ridiculous clip here, and it will hurt us in the end if we stay that way. But when all things are relative and the markets are this volatile, and there's all these externalities that are taking place, this is the best place to be for now.
There will always be opportunities.
Exactly.
It's just better to take in our opinion, a more conservative defensive approach given the current environment that's out there.
Yeah.
So all right. I'll read the first one.
Okay. Where do you want to start?
Where do you want to start?
Well, why don't we start?
Okay, so this is an interesting question, because there were actually two questions about stable coins of all things. So before I go into the question, just so everyone's on the same page and understands what a stable coin is, I'll just give a real quick overview. So there's all this talk of digital currencies, cryptocurrencies. There's ways to basically put assets on blockchains, on these digital platforms that represent or are backed one-to-one in the real world with dollars, held in a vault or something somewhere. Sort of the same idea how you log into your bank account and you see numbers on a screen. Same thing, except instead of the back end being a bank that's custodying that, it's this peer-to-peer distributed network that's theoretically custodying that, or the specific stablecoin issuer. Make sense? So the question is, should people be putting a percentage of dollars into digital US treasuries, or Gemini dollar, or different protocols that offer these types of stable coins because they make a higher APY or APR?
And they're questioning whether it's a safe place to park cash.
Right.
So
there's significantly different risks with your money in a bank. Obviously, it's FDIC insured. There's insurance on that. You have guarantees of government backing those assurances. With stable coins, those do not exist. Yes, you can get much higher yield on them. I think I've seen anywhere from really 4 to 20%, depending on how risky you want to get with them. But there are many more risks, from smart contract risk, platform risk, issuer risk, all the different types of technology risks, self-custody risk, that the inexperienced user might not be familiar with.
And the other thing is like, because the crypto market is so new, like even when if clients decided to open up a crypto account with us, we are very, very clear that don't put anything in there you're not willing to lose at this time. We just can't. Even though we're believers in the technology and we're believers in the direction.
It's still nascent. It's still new.
It's still new. And especially so when we see the word, as far as it being a safe place to park cash, I mean, we can't even say that. We can't even say that, at this point.
Right. Is it a place to park cash to get more yield on? Yes, but you are taking on different more risk. So I think that answers that.
Yep, it does.
All right. So do you believe that a stablecoin properly structured and transparent about the actual assets backing it will become an alternative to government money?
Okay, I'm gonna read this so it's clear for everyone. The question: do you believe that stablecoin, properly structured and transparent about the actual asset backing it up, will become an alternative to government money?
So I'm going to say
yes.
Yeah. Most likely, there's a few different camps of thought around how this happens, right? Money always, the medium people use for money always changes. It may seem like it doesn't, but in the early 80s or late 80s with credit cards, people were like, no way plastic is gonna be in my wallet. That's absurd. Nobody's gonna have that. And now it's ubiquitous, right? Same with people using their phones with Venmos and PayPals, those kind of things. The mediums in which we use to exchange are always changing. Moving really towards things that are more efficient over time. And these stable coins do truly offer a more efficient platform. Again, it's still early. These things take a lot of time. But two ways that this could happen, to get back to the question. The first is through a central bank-backed digital currency, where the Federal Reserve or central banks around the world.
And there is some talk about that around the globe.
Right, issue their own currency that way. Or you have sort of like a hybrid Silicon Valley corporate coin that is, partnered in some way with government to issue these dollars, knowing that they are backed by real dollars custodied in a bank vault. One of those two ways, it could be a mix of that, but yes, most likely this will be happening. In the future, and it's already starting to. A lot of the infrastructure has already been or is being built. You have huge companies that are already looking at ways to do this and how they can facilitate global payments on these crypto rails using this kind of technology.
Yeah, and it's fair to say when Paul and I first started, really, when we decided to have our offering starting a year ago with Willow, I mean, one of the thesis was that this is the direction we believe that's taking place. And we do know that there are countries that are starting to review this as an option for their countries. So in fact, I think we might get to that with a question down the pipe. Yeah. Okay. I'll read the next question. I read that BNY Mellon, which is Bank of New York Mellon, which by the way is the clearing firm we use is Pershing, which is a division of Bank of New York. The 230-year-old bank wants to be king of the back office services for crypto ETFs. The firm has 90% market share in Canada. Do you see the firm expanding in the US and providing tax and administrative services? So, yes, I see them expanding their custody in this area in the United States for sure. If they don't, they're missing out on a big leg of where custody is going. We are seeing that cryptocurrency is gaining more use and gaining more acceptance, and we do continue to see companies wanting actually to make cryptocurrency a legal asset so that they can start showing that on their balance sheet.
I think once you see more regulatory clarity or more frameworks developed at the national level, then you'll see a lot more of these firms really lean into offering more of these types of services.
This question, do we see the firm expanding in the US in providing tax and administrative services? If that's relating specifically to crypto, I would say yes. Most definitely. All right, next.
All right, so do you think the biggest implications for the US of the Russia-Ukraine military conflict is likely to be whether the US response to the conflict emboldens bigger economic rivals, namely China? If so, what does this mean for a long-term investment landscape?
The answer is yes.
That's a great question.
With all the discussion around shutting Russia's SWIFT account down, they're going to have to come with some sort of option. China already has that option.
Right. China's been working on their own digital central bank-backed digital currency since 2015. So
I want to point this out to you because the mainstream media says that China's falling behind in this area, and it's not true. Right.
I mean, it's a closed door, closed economic system, but they're years ahead in terms of research, how to pilot these things, how to move their entire nation of billions of people to adopt these types of systems. From a sort of totalitarian standpoint, it does provide them amazing insight into and control over the money of their people, which is, I would say, scary. And not a bastion of freedom, right? But they've been building this infrastructure out since 2015. Now with Russia being, or the talks, I don't know if they've officially been kicked out of SWIFT yet, but China could be standing there with open arms to say, hey, use our system. They're already trying to, with all the different Belt and Road initiatives, which is sort of China's trade with other countries, to bypass US dollars anyways and use their own system. So this will be very interesting for them to see how it plays out. I think that, honestly, I think China's sitting there really happy with what's happening, because not only do they get to see how the US and the rest of the Western world responds to a country like Russia moving into maybe more NATO-aligned country, and are basically maybe looking at that to say, hey, let's see what, how the world responds to this, because if we wanted to do something like this to Taiwan, we really know what to expect.
And then the next question, so is if so, what does this mean for the long-term investment landscape? So, this would mean
U.S. hegemony, which basically could mean
the dollar. I mean, I would think the biggest risk we would have here is the dollar, is the viability of the dollar, and this, in terms of trade. Remember, the dollar is the biggest reserve currency around the world. It's what OPEC is based on. Honestly, does this change all of that? If we're changing the balance of power, I think it can. And I would say that would be probably one of the largest concerns. And I would argue that with oil going to $110 a barrel, that we may have lost already some control. We've been talking about that.
It's been a concern of ours for a while, and it seems that it's moving inch by inch, but moving in the wrong direction.
We were energy independent not too long ago, so this is a big game changer. I think this is something that I don't know how others are not paying attention to this at this time and asking that question. Please go to your senators and Congress people with this question.
Why?
What are we doing here?
Don't stifle innovation. Support it.
Yeah. Okay. So, what guides your decision on the percent of portfolio held in cash? What range and what range of percentage results? Okay. So, our decision is based on the charts that we actually showed you. It's where are we in the macroeconomic cycle? All of the charts that we showed you today is showing that we're nearing and rounding the end of an economic cycle, rounding the end of an economic boom. Okay, so when we see that and we see some of these indicators ticking up, seeing a deterioration in the market, and then of course we have the externalities of the geopolitical situation, that is going to say to us, we need to raise cash in the portfolios. That's what guides us to it. What percentage? We will, it's always, we're playing with this. So 30% depends upon the severity of what we're seeing in the numbers. We've been inching up in cash more and more. And we're not regretting the decisions we're making there. We think everything's pointing towards that being the proper call at this time. So hopefully I got that.
Yep.
And where are lifestyle investments that will be necessities regardless of all the craziness?
I mean, it comes back to some of the main themes that we've talked about.
Yeah.
There's certain staples, certain energy things, water type companies, certain technologies too, certain healthcare things. But again, it all comes down to, as we've been saying, to the cycle. Right now, even if something has a great, plans over the next decade or so, something that could be really useful for humanity, it might not matter so much in terms of the price of the asset currently. So like markets and sort of that reality are divorced and a little bit there and don't always match up perfectly, which is why we look to our indicators to really tell us, okay, how much risk is really out there? When would be a good time to, even if something's a great idea, we still might want to just sit and wait for some of that volatility and craziness, right, to pass or get resolved in some way before entering back in.
Yeah, definitely. And then someone asked, is this a follow-up question about the crypto market? How do we know what to invest in? Anything? With China, I guess control. So if they control the crypto market, okay. So we want to. So somebody's questioning whether China is controlling the crypto market. They are not controlling the crypto market. This is not what we're talking about. They are creating their own government-backed currency on the crypto market.
Right, they're creating, theirs is really its own closed system. So they
Yes.
have this digital yuan that operates on their unique rails and their unique system that is completely owned by the the PBOC.
Yes.
Right, and it doesn't really. I mean, arguably, it could be tangentially related to swings in the regular crypto market, but they're two different things.
Yeah, yeah. So that's really important.
Yeah.
I had a point that I wanted to bring up, and now I can't remember what it was. Okay. Well, it's come and gone. If there's any other questions, feel free to write in the chat box. That's what somebody is doing right now, and we'd be happy to answer your questions. Or you can even raise your hand if you're not shy about speaking. You're more than welcome to do that as well. But overall, again, we want you to know that, just raise your hand if you want to talk. Overall, we just want to make sure you know that we're on this. We don't like the tone of what we're seeing right now. And it's really, Paul's been in the industry since we've been in pretty much a bull market. So this is the first time.
Right in 2009. So
Yeah,
right after the great financial crisis.
Yeah. So this is this is fun for me because this is a teaching moment for me with Paul that I can show him. I mean, he already has all the right instinct anyway, but this just, for me it's invigorating. I hate to say this, please understand. I don't like to see things unravel, but it's an invigorating thing for me to actually teach him everything that I know of how it all unraveled. So right now, again, patience is really important. This isn't the time to be looking for big returns. This is the time to be just sitting back, being more of an observer of what's taking place. Ice water running through our veins. Certainly, I know it's like reacting emotionally to what's happening. Pay us not to be emotional. And, we're just straight not emotional about this, and we shouldn't be. Do we have another question?
One last question. Around just when can you expect a copy of this record? Yes, we do record these, we do post them. Usually it should be about a week at most. Yeah. So investwithwillow.com/insights is where all of our posts will go. So check there in a week. We try to do a roundup email at the end of each month with links to all this stuff, but usually within a week or so.
Somebody's asking about support. Let's grab, can you go in and grab TradeView so we can show? Somebody just asked the question, the market indicator chart looks quite negative. Yes, we agree. Where is the level of support? So one of the things that Paul and I look at are these technicals in the market, which they don't lie. And here's something that I learned a long time ago. They don't lie because somebody knows something before we do. So there's insiders who know more than us. Will this go, how far back will this go? Okay, good.
And this isn't shared.
Okay.
All right. We're going to share the screen and show our chart so we can.
Oh, it's cold. I'm waiting for summer to. I mean, spring. I'll take spring. Okay, so Paul, is there any way to zoom out this a little bit? Okay, we're here, right here. So it looks like right at this moment we are sitting at support. Yeah. Draw the support lines in. Yeah. Okay. So the line that Paul just put in is support. This is where we would expect a bounce to take place. So you can see this first support, if you can point here, Paul. It bounced, came back down. We're testing again, penetrated a little bit, and now we're bouncing again. That's a very normal chart pattern. Paul, can we go back and see where we would see support? If we penetrate there, what would you say right about where would we be? This is how far back are we?
Back to August 2020.
Oh boy, this is.
Yeah. I mean, see, so markets have gone like straight up since the bottom. So I like
mine. Hold on, I'm going to grab my chart. I'll be right back.
Some of us.
I just have to look at my chart, like I have a different chart system than his. It's all the same data. It's just I look at it a little bit differently. Just let me get in here and look. Can you discern something on there? Or no?
There's definitely support. I mean, this is the fib retracement here. So the red line here. This is like a,
so that's where I am. I'm looking,
Yeah.
I'm going back to the beginning of 2021. That's where I'm looking. End of 2021. Where are you?
in the 20, this range.
Yeah. Yeah. So I would say, what are we,
Right.
10% from there? From where we are?
A little more.
A little more, so 15%. That's what I'm seeing. I have a different charting system that I like that, you know, I've been using for 30 years, so
It's
don't
about
change
12,
me.
it's about 12%.
Yeah, so about 12% from here, we would hit another support level.
Mhm.
Like what it does at that level, I mean, if it goes there, what it does would be the big question. So.
So the question was just, can you explain what support means?
Yeah, so what happens is the markets create, you can see this, they create this kind of patterns and where the touch points are. So a support level would be where.
I think this is a really easy way to explain it. You see this blue line?
Thank you.
This is called a moving average, right?
Thank
And you
you.
can see that
Yeah.
it hits it and bounces and sometimes goes below, but generally stays around that moving average. Then it broke through it here, and now it's hitting the bottom of it and almost bouncing off.
Right.
So support was the line
That's one.
in one way,
And
right? That's
there's
one
so
way.
many, yeah, there's so many ways to look at this. And then here's the support that Paul drew.
Mhm.
So when the markets hit a level, you can see they kind of hit right here, the same level, that becomes support. That becomes support. But this is something we can, you know, go over individually if you
Yeah.
want us to. Okay, so what else? Anything else, or did we get it all?
I think that's
We
it.
got it all. Okay.
So, yep, if you guys have any other questions or comments, concerns, you'd like to have a meeting, shoot us an email, give us a call. We're always happy to chat.
Exactly.
All right. So on that note, thank you everybody for coming and take care.
Thank you.